The first valuation model is free cash flow model. The model is preferred to the DDM, dividend discount model, as not many companies pay dividends, or when dividends are hard to forecast. Same as DDM, free cash flow assumes that free cash flow at some point will grow forever at constant growth rates of free cash flows. This is what we call horizon value or terminal value. The idea behind free cash flow is to use only cash flows from operating activities up to 1 year, EBIT, earnings before interest and tax, from the P&L. So you deduct profit tax from that, after profit tax, okay, and investment in net working capital from the balance sheet, and cash flows from investment activities, what we call CAPEX, capital expenditure, also from the balance sheet. So there are no finance activities here. This is why we call it free cash flow. No lenders, no bankers, we are free. Free cash flow model basically works on the same principle as the dividend valuation model. Only difference is the valuation of the free cash flows instead of dividends. The free cash flow formula that you can notice, so every year you discount your free cash flows going forever, like dividends. You discount them with the expected return, expected yields. So the free cash flow model, it's a very popular method for valuing stocks, as it focuses on the actual cash generated by a company from the operating activities and investment activities, I remind. Once we get it by adding first couple of years where we discount free cash flows for every year, and then we add a discounted terminal value or discounted free cash flows going forever, we obtain then the value of the company. So let me remind you what is the free cash flow. Free cash flow is equal to the EBIT, earnings before interest and tax, so it's from the P&L, okay. Operating income, you multiply by 1 minus T, or profit tax rates in your country, to get earnings before after tax, or earnings before interest but after tax, plus you add back amortization, depreciation, this is a non-cash item, to remove it, minus annual investment in assets, in capital expenditures, CAPEX, and minus investment or net working capital investment in your net working capital, which is short-term assets / short-term liabilities. CAPEX, you find it in balance sheet, net working capital in balance sheet on up to 1 year, amortization from the P&L, and EBIT from the P&L as well. You put it all together, you see here that you have operating activities, EBIT, amortization, net working capital up to 1 year, and investment activities, CAPEX is here. To get the value of the company, as I have previously explained, you consider all free cash flows of the year 1, year 2, year 3, and so on. To not go forever, it's impossible. The idea is to use discounted terminal value. Okay, what is the discounted terminal value or horizon value? You can take one free cash flow at a certain stage, and you consider that such free cash flows either grow by growth rate of free cash flows forever, G rate, or free cash flows are same forever. If you have growth rate of free cash flows forever, this is like a Gordon model. You just divide one such free cash flow divided by the what we call WACC, weighted average cost of capital, less G rate, growth rate of free cash flows forever. Or if there is no G rates, free cash flows are same every year, you just divide free cash flows by the WACC, weighted average cost of capital, that we shall see in the optimal capital structure lecture. So all such free cash flows plus the terminal value, you discount it by 1 plus WACC to the power of 1 to the power of 2, and a few years like that, you do a sum and you will obtain the value of the company.